How's it going, guys? My name is Jared Ace and welcome back to MoneyMetEish. Today we have a bit of a different kind of video. We will be speaking to independent analyst Jimmy Moyaha about what inflation is and how we can prepare our portfolios for a high inflation environment, as well as what we can expect from the US Fed beginning tapering and the South African Reserve Bank raising interest rates. Before I cut to the conversation, please remember to hit that like button, subscribe to the channel, and ring the bell to be notified whenever we upload new videos. Also, keep in mind that my videos are meant for edutainment purposes only and should not be used as the basis for any investment or financial decisions, as I'm not a financial advisor, this is not financial advice, and this is not a blank cup. The Tenacity Leather Studio online store is open, and now you can also own your very own exquisite leather products like this wallet, or this notebook cover, or even this coaster, by visiting their online store. You can also check out their range of exquisitely designed and handcrafted products made from full-grain leather sourced from one of South Africa's oldest tanneries on Facebook or Instagram. Links to everything in the description below. Jimmy, thank you for joining me once again.
Always a pleasure, Jared.
So, Jimmy, we have seen inflation rising all over the world in the last few months, and the markets really have been through a roller coaster in the last few weeks, with the Fed saying or stating their intentions to start tapering, and with the SARB beginning their interest rate hiking. That was all before we got this new variant. So before we go into how to prepare for an inflationary environment, please could you just explain to us what tapering is for the layman?
Sure. Before we get into tapering, we probably need to start with what leads to tapering and why it exists as a concept. There's this concept called quantitative easing. Now, simple English, it's when a central bank does certain things. They buy assets or they increase the supply of money in the market to stimulate the economy and stimulate lending and investing and actually increase the supply of money within an economy. The central bank comes into the open market and, for example, purchases bonds within the open market. Our central bank's done it, the Fed's done it, and that sort of thing. What that does is it injects more money into the economy, and they do that in the form of long-term bonds. That's one method they can use to do that.
The proverbial money printer, where we see that meme of Jerome Powell with the...
And the idea behind that is to spur economic activity. You've got more money in circulation, more money in supply. You want to then encourage your people to borrow. You want them to invest. You want them to use that money to generate more money and thus get increased economic activity. Now, there's a point where the central bank decides that they are going to stop that. They're going to stop the quantitative easing process. And that's what's known as tapering, is the scaling back of that injection into the economy. Because obviously they can't just one day say, here's $700 billion, and then the next day be like, you know what, we're done, So it's a gradual decline or decrease in that purchasing. So if you look at what the US is doing now, the US is tapering at a rate of I believe it's some $15 billion per month. So when they initially bought, they were buying about $120 billion worth of bonds. So now to scale that back, every month they're now buying $15 billion of bonds less than they were in the previous month. And the idea of that is that at the end of 6 months, at the end of June, they will have basically gotten back to a point of zero of adding towards the money supply within the economy. Now, when they do that, they also look at things like inflation, and that comes in at a different point, because so if you, again, base level understanding of what inflation is, it's the increasing costs of things on a periodic basis. Typically what they do to measure inflation is you measure the same sorts of products. How much did a loaf of bread cost you in month 1? How much does a loaf of bread cost you in month 2? Has that price increased? If yes, then there has been inflation or there's been an increase in price. So, and that's the definition of inflation: an increase in price, in the price of goods, in the price of services, various things. So from an inflationary standpoint, if your inflation is increasing, then your cost of living is becoming more expensive. Your cost of interacting, your cost of transacting is becoming more expensive. And what that then prompts institutions like the central bank to do is to then use interest rates as a mechanism to curb that inflation. So in hiking interest rates, they then aim to curb the rising cost of inflation, which is what the South African Reserve Bank has done. Now, the practical way that makes sense is if things are becoming more and more expensive to consume, and there's money in circulation, the increasing of interest rates means it's more expensive for you to borrow. It's more expensive for you to interact, and therefore your purchasing power is going to decrease, which means you're going to be less economically active. And as a result, they're hoping that end result then reduces inflation, because the cost of things only really goes up as things are consumed more. Nobody's going to one day decide, oh, I'm selling apples, nobody's buying my apples, so let me increase the price of my apples. People increase prices when consumption is high. And they're doing that because, one, you can make more profits. Two, it might cost you more to bring in more stock. You might have to deal with other things as a supplier and that sort of thing. So as the consumption of things increases, inflation rises. As they increase interest rates, the idea is to then reduce that power of inflation and sort of get things balanced out. It then leads to what you can do from a portfolio perspective to ensure that you're sort of covered. There's very little you can do in certain situations, like in the world that we just saw the virus. Inflation was global. It wasn't country specific. If it's country specific, your typical measures, you have exposure to assets in a different country or a more stable country, that sort of thing. But when it affects everybody, then it's a different conversation.
So with that in mind, then, what sort of investments would you sort of be looking at in a high inflation environment? What companies would you be looking at? Would you necessarily be looking at equities? Would you look more at harder physical assets like property? What sort of investments would you go into?
So again, in understanding what inflationary hedges are, you just need to be reminded of the concept of inflation. It's the rising of prices that negatively affects your currency. It reduces your purchasing power, and it means that you basically get less for the same amount of what you had, right? So if you had 10 Rand and you got 10 lollipops, you now get 9 or you now get 8 because the cost of things has gone up, right? Now, your base inflation hedge, your most common inflation hedge is gold, because gold moves in the opposite direction to the US dollar. If the US dollar strengthens, gold will typically weaken. And again, the US dollar is the benchmark in terms of global currencies, right? So when inflation goes up and the cost of things goes up and people have less purchasing power, and we don't know how long that's going to last, or the central banks are going to then increase interest rates to adjust for these sorts of things, gold is your inflation hedge against the dollar, primarily because of the strength of the dollar and its use, its wide use in the world. So that's your most common starting point that people tend to look at, is to say, okay, inflation hedge, time to go into gold, and you'll see the gold price will rally and then that sort of thing. So you can invest in gold via a CFD. What you can also do is you can also look at mining stocks that mine gold. So Anglo Gold Ashanti, Gold Fields, Sibanye in South Africa. And the reason for that is because as the price of gold is going to go up, if they're producing gold, it means they're going to sell more.
So with now us having looked at inflation, we now understand that one common way to counter inflation is by raising interest rates. And we've seen this with the Fed stating that they are going to start tapering, like we said, by 15 billion a month until they eventually get to zero. We've also seen the SARB raising interest rates recently. So if we do get to a point where interest rates are a lot higher than they are now, what sort of companies would you be looking at then?
That's quite simple. Who stands to benefit from the interest rates increasing? If the central bank, exactly, so if the central bank raises the interest rates, then the commercial banks raise the borrowing rates that they borrow to you, which means that they borrow at a higher rate, which means they make more money. So your financial stocks.
We're looking at banking stocks in a high interest rate environment.
And you're also looking at high-yielding bonds, much like the South African bond. But what that means is that you're going to go buy a South African government bond, which then in simple terms means you are effectively loaning money to the South African government by purchasing that bond. You become their lender. Because at the end of the day, with the yield that's associated with that bond, when that yield does materialize, you then make and more often than not, your emerging market bonds, like Argentina, like Brazil, like South Africa, like Turkey, they
Not this
offer
month.
you, not this month, they offer you more attractive returns, right? They offer you a higher yield than some other conventional. And so the advantage to things like those emerging market bonds is you sort of know the yield ahead of time. You can't necessarily predict that the Tesla stock is going to rise by X amount, So your government bonds from emerging markets in particular, and stable emerging markets or attractive emerging markets, is where you could also find, in a high interest environment, you could also find a bit of a good return from that perspective.
I also think, there are bond ETFs that you can look at as well. I think Cloud Atlas has an
110%.
Africa tracking bond ETF where they look at different countries in Africa. There's that option as well.
That is definitely an option, especially if you're going to look at a place like Argentina, where you don't want to be necessarily exposed to just Argentina, maybe the South American countries as a whole. You've got those options. So your emerging market bonds, your ETFs, but mainly your financial stocks as well, because they're always going to do well in that time as well.
Jimmy, it has been a pleasure, as always. Thank you so much for spending this time with us again, and I will chat to you soon.
Awesome. It's been fun.
Thanks for watching, guys. If you liked this type of video, please let us know in the comments down below. You can also contact MoneyMetEish via email at moneymeteish@gmail.com. You can also follow MoneyMetEish on Facebook and Instagram and everywhere where MoneyMetEishes are. Thank you and good night.